you take a look at how things have escalated. It seems like this is the week where things get a little bit more real. Lee, do you think that the risks at this point are still manageable from the U.S. and China side? I
think the risk is the market still expects a deal to be made. Yeah. There is this idea of a playbook that President Trump uses from his sort of art of the deal days, whereby he goes in big with big statements, big sort of goals, and then you negotiate and you get a sort of a smaller deal and everything is fine and he can claim a victory. And there's a view that's the playbook. My concern is on this one is that trade and his idea of unfair trade against the US has been his view for 30 years. You can find interviews back in the late 1980s where he talked about unfair trade with the US. Yeah. And also it plays well in the opinion polls. His approval rating goes up every time he talks tough on trade. So it plays very well with his base. It's something he actually believes and has done for 30 years. And this is why I think he's going to see this one through, and this one could well end up in an escalating trade war.
So you think China would actually blink in light of it? We saw some reports that perhaps they might be quite limited here when it comes to restricting investment into China, because that's still one of their main goals. So they can't really restrict the U.S. companies operating there to a certain extent as well.
No, that's right. But I think, you know, you can do other things. Yeah. And it's not just China, it's the rest of the world. So I think the rest of the world will be emboldened to stand up to this, because it's not one country, sorry, it's the whole of the world. And I think, you know, nobody wants to see trade tariffs, nobody wants to see, you know, a reduction in global trade. And I think they will try and get Trump to blink, but I'm not sure he will.
Yeah, and for all of this, you know, trade war-induced global equity declines that we have seen for much of last week, at least in this part of the world, I have a chart to kind of show this, Lee, but where volatility has been across assets. And I guess you could say we're still pretty tamed if you take a look at FX volatility, stocks, as well as bonds. You could blame it on the World Cup, I guess you could say, Lee, but, you know, why do you think there's still so much calm in the markets right now? And what if these trade talks continue to simmer beyond the World Cup?
Well, I mean, I think, you know, the calm is because the market still thinks the deal will be done. Yeah. So I think, yeah, we see sort of short-term reaction to it, but the market underlying still thinks the deal will be done and we won't actually get to a trade war. So that explains some of the calm. And yeah, I also think we are entering the summer months, as you say, and the World Cup is on, and that helps. But the other thing is that QE from the central banks at the moment is still positive. So if you look at the G3 central banks, they're pumping in around $25 billion a month. Now, this is down significantly from last year. So last year was about 125 billion. It's now 25 billion. That's why volatility has started to rise. The second half of the year, though, is the real test, because that's when it becomes a net drain. Basically, from September onwards, as the LTROs roll off and then we get into less printing from the ECB, we get a net drain in liquidity, and that's the real test. And I think leading up to that, I think volatility is going to continue to rise from here. I think what we're seeing now is a little bit of an expectation that it's still 2017 and everything's fine. I think the reality will start to hit in the second half of the year.